Good morning and welcome to the Killik & Co podcast for Friday the 21st of November. It's been another busy week this week with updates from the four major economic blocs. The first was Japan, where we saw a poor GDP number which fell 1.6% against a forecast 2.2%. This is actually probably good news over the long run for the Japanese market because it means more weakening of the yen, and therefore, as we can see here, the Nikkei is very closely correlated to the US dollar yen rate, and we saw that continuing to weaken and therefore strengthen the Nikkei. In the US, we saw continued acceleration of their domestic economy. The Philly Fed, which is the Philadelphia Manufacturing Index, showed an extremely high number, the highest since 1993. We also had very good US home sales data in the US. This is at the same time that the Fed are continuing to sit on their hands. So in the Federal Reserve minutes that we saw this week, we saw that they are still fearful of signalling interest rate rises. So they're not changing that language of keeping rates on hold for a considerable time. This is because we saw in May of 2013, they managed to slow the economy down quite dramatically when treasuries went from 1.75 to 3% on more hawkish language coming out of the Fed. They also said they are aware of the impact on the US economy from a slowing global economy, but they're very confident of the domestic strength of the economy at the moment, so they weren't doing anything about that. In the Eurozone, we continue to get fairly lackluster data. So the PMI numbers came out of Germany this week were pretty poor. We did have a better reading on the ZEW confidence number, and that's suggesting that business confidence is starting to pick up, and perhaps some of the benefit of a cheaper euro and lower input costs are coming through in terms of people's confidence. But in China, the PMI number was poor, so that missed expectations. We saw further falls in iron ore, with iron ore touching $70 a barrel, $70 a ton, or a 5-year low this week. What that has stimulated is a rate cut in China, and we started talking about that last week. The market was anticipating that, and we got that this morning. We've got a 25 basis point cut to the 1-year rate and a 40 basis point cut to the 5-year rate in China. So as we can see, the iron ore price and the Brent crude price have been very weak year to date. Iron ore down 47%. So that's put a lot of pressure on the mining sector. We're seeing a bit of a rally in that sector this morning on the rate cut, and equally in the oil stocks as well. In Europe, are we starting to see value yet? I mean, that's a question that we are asking a lot internally. As you can see here, European earnings have lagged US earnings significantly. We haven't seen the uptick in earnings that we've seen this year in US stocks in Europe. And therefore, perhaps there's some optionality in the valuations of some of the European stocks. And here this week, we recommended a switch out of Boeing into Airbus on valuation grounds. So here we can see the comparative PEs of Airbus against Boeing. As you can see at the moment, Airbus is slightly cheaper than Boeing on a 2015 estimate, and by 2017 it's got considerably cheaper, so 30% discount by 2017, and that's because Airbus's earnings are growing quicker than Boeing's. The week ahead, it's fairly light on the diary. So we've got, on Tuesday, we've got Severfield Rowan, which will be interesting for UK construction. We've got Topps Tiles, equally for the home DIY market. We've got Compass and Wolsey on Wednesday, so more data in terms of the housing market. And we've got Marston's, and then on Friday we've got Helical Bar. On the macro data, we've got the OECD Economic Outlook, which is closely watched. We've got the University of Michigan confidence numbers. We've got money supply numbers from Europe. Sorry, you've got the GDP number in UK on Wednesday as well there. And finally, we've got CPI or inflation numbers from Europe on Friday. So just looking at Wolsey, which is next week, that stock's been very strong into their numbers on upgrades. That's reflecting the good macro data we're getting out of the US in terms of housing starts. And here you can see 64% of their profit comes from the US. What we like about Wolseley is it's also got that optionality we're talking about in terms of an uptick in European earnings. So we'll see if that's starting to come through next week. Thanks very much.